S&P 500 and NASDAQ again hit all-time highs. Small caps are lagging. We'll see if this means anything in relationship to the general state of the market. The put-call ratio is currently favoring a market correction. I will explain that in detail. And interest rates are coming down as Treasury bonds are rallying. Dollar is holding support while gold looks vulnerable and it could correct further. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, June 14th, 2024. As always, please hit the like button, subscribe to this channel, share this video, ask any questions you like in the members only in the comment section below. If you're a subscriber, stay tuned. We will cover various securities, for example, market breadth, crude oil, and natural gas will be covered in the members only section. The ETFs, large cap stocks, and the speculative stocks, as well as gold miners, will also be covered there. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which are available for TradingView.com. If you need them, please sign up and I will open the door for you on TradingView.com. S&P 500 has gapped to new records a few days ago. So notice this gap up from between the 11th of June and the 12th of June. This gap could be interpreted in more than one way. This could be an exhaustion gap. So exhaustion gaps happen when security has trended for a long time up or down, and at the very end of the trend, at the very end of the move, it gaps in the direction it was moving before. So that could be an exhaustion gap, meaning that this is the end of the run, and now we're going to be turning around and heading down. But notice this gap right there between 13th of November 2023 and 14th of November 2023. This was in this case this was a runaway gap or breakaway gap. So can we see something similar? We can. It's just that this particular rally was so strong and it continued for so long that I think corrective action is really close. And I will also get to the market breadth and I will explain why I think we are very close to a general market correction. So corrections usually happen, it's like a normal thing. During an uptrend, we have corrections, but those corrections are usually opportunities to buy. We just need to see a deep enough pullback. So, for example, this back in July of last year, 2023, this was an all-time high at the time. And we got a correction, we got a pullback, and it pulled back towards the blue support resistance line around October of last year. And this is where we bought. So we want to see something similar. I would like to see a pullback towards the blue support resistance line, which is currently about 8 or 9% away. And at that point, we will make a decision. Do we want to be buying at this? Do we want to be buying or do we want to be doing nothing? Most likely at this point, we still want to be buying. There is just not enough evidence to say that we have turned around and now we're going to be going down. We're at all-time highs, so usually this type of trends just rarely die. Usually they continue for some time, and we'll see if that happens in this case. So that's S&P 500. We can look at weekly chart. Weekly charts look even better. So there's S&P 500 on weekly charts. Then basically that's the way we trade. We look for a pullback or a breakout above the blue line and we just buy it there. So for example, the latest opportunity to go long, to buy, was in October of last year, 2023, and now we're seeing continuous record highs. So that's S&P 500. Here's NASDAQ, QQQ. Also a very strong move. QQQ, NASDAQ actually had no opportunity to buy For example, this pullback in October of last year, 2023, and another one in April of this year didn't really come to the blue line. For example, S&P 500 did come to the blue line back in October of last year. So NASDAQ has definitely been stronger, outperforming S&P 500, new record highs. I personally am still holding NASDAQ. I bought NASDAQ back in January of 2023, last year, so a little bit over a year ago. Opportunity to buy NASDAQ right there where I'm hovering in April of last year, and really no other opportunity since. So as far as small caps are concerned, small caps, you can kind of see that small caps did not yet make an all-time high. So this is an all-time high that was made in 2021, and small caps have been lagging relatively badly since. However, they're still in an uptrend. When we see a security close above the blue line, we're just saying it's in an uptrend. And it's currently in an uptrend. We're about 18% away from record highs. And basically, small caps are underperforming, but they are not bearish. They're just underperforming. So maybe we'll see another opportunity to buy small caps. So basically, we're looking for a pullback towards the blue line, and we're buying it there. So again, pullback towards the blue line is, for example, here back in April of this year, and then we bought it there. A pullback again towards the blue line would set it up as a nice potential setup to be bought. So for now, basically stocks are reaffirming an uptrend. In a few minutes, I will show you put to call ratio, and I will explain why there is a chance that we might be pulling back in the near term. Okay, so let's look at a measure of market breadth called put to call ratio. So on StockShares.com, it's $C like cat, P like Paul, C like cat, CPC. So put to call ratio. Puts on top, calls on the bottom. Put is a bearish bet. Puts are bought when security is going down, when people think the security will be going down. Calls are bought when people think the security are going up. So calls on the bottom, puts on top. When we see a pullback in favor of calls, we will expect a correction. So when we have so many calls that pretty much everybody under the sun thinks that the stock market will continue higher, it's usually a recipe for a pullback. Vice versa, if we have a lot of puts, everybody thinks that the stock market will collapse and go to zero. That's a recipe for a rally, actually, the other way around, the opposite. Is this a perfect indicator? No. And it also is a relative. So, like, for example, we're looking at a relatively large amount of puts when we're expecting a rally. So, for example, this was a huge outlier back in October of 2023. Look how far away from the midline the reading was in favor of bears. Okay, and then we got a rally at that point, basically, in October, November, huge rally. The opposite is happening when we have so many calls, more calls. We're expecting a correction, and this happened back in 2023 in February, small correction here, and another one in July, August of 2023. We got a nice correction here. So it's not perfect. So, for example, here we had in April of 2024, we had a significant amount of puts, quite a bit of puts, yet we got a pullback. So it's not a perfect one-to-one. Right this instant, we have a so many calls that we are hitting a very close to 2-year low in favor of calls. So I think pretty much everybody thinks that the stock market will continue higher at this point, and this is definitely a recipe for a pullback, a recipe for a corrective action. So currently we have 0.87 ratio in favor of calls, and this means that again I'm expecting at least some sort of a corrective action to relieve this very large readings. I mean, we're approaching a 2-year low, and in fact, if we hit this, if we go below this July 2023 lows, then we will make a multi-year low. Let me see, how far are we? I mean, if we break below this low, we could actually get multi-year lows on this ratio. It hasn't yet happened, but we're definitely very close right there. So this is the put to call ratio. It's one of those indicators that is not that only makes sense when it is an extreme level. So it's either too many puts or too many calls, and at the same time the market also is showing signs of either being overbought or oversold. So currently we are in an enormous amount of calls. Again, everybody thinks that the stock market will go higher, and we are at all-time highs. So together, taken together, I have a feeling we're going to be correcting very shortly. Okay, so let's watch for a corrective action. It could be a small correction, but I think this reading is really very overextended, and I think we might be correcting pretty soon. All right, let's continue. Let's switch gears now. We're looking at Treasury bonds, TLT. This is a long-dated Treasury bonds. This is sort of like one of the safest investments you can think about. Long-dated Treasury bonds. I mean, they do move somewhat significantly, but they also control longer-term rates. And let's look at those first. So TYX, this is a 30-year Treasury bond yield. And if you remember, yield and bond prices, they move in the opposite direction. So actually about in May of this year, I mentioned that interest rates was going to be coming down, and I drew in this white dotted line. We're following that dotted line exactly. We're coming down. So we came down from about 4.6% to about 4.3% for a 30-year Treasury bond yield. As far as 10-year bond yield also has come down. Back in May, I mentioned when I mentioned it was about 4.4. It is currently at 4.2. So definitely we're coming down. The reason why that is happening is because bonds are rallying. So there's the Treasury bonds, TLT, and notice that they're moving higher. In fact, I just recently bought myself TLT. Why did I buy it? I pretty much follow my system, and I buy on close above this blue support resistance line. Again, you can find out more about these lines, and you can get them on your chart. So I buy on close above the blue line. I send alerts to my subscribers. So far, I am in a small plus, approaching the target. Target is not that far off. So Treasury bonds. Another way to think about Treasury bonds versus stocks is the sort of like a seesaw. So when Treasury bonds are rallying, it means that people are worried about the future, and stock market is stocks are technically considered riskier assets than Treasury bonds. Right this instant, stocks are at all-time highs, but at the same time, we're seeing bonds rally. So perhaps we're seeing fear increase in the market, and coupled with my assessment that we're definitely overextended in favor of calls, in favor of bulls, all of a sudden we have Treasury bonds that are rallying and breaking out. So Treasury bonds is considered kind of like they're bought during times of stress and fear. So it looks like we're seeing that time of stress and fear come back into the market. And we'll see again if a pullback for stocks is about to unfold. Just in case, I bought Treasury bonds a few days ago, and I'm going to hold them for now because, I mean, if stocks do pull back, then Treasury bonds usually will benefit from this action. All right, let's switch gears. We're currently looking at dollar currency index, DXY. So notice this upward facing arrows. Dollar has broken out into a new uptrend by closing above the blue line. We had another signal just recently. Not how many signals we had to buy the dollar. Recently we had another signal, and now we're actually at the highest. We broke to highest level since May of this year. So good news as far as dollar bulls are concerned. What we're seeing is right now we're looking at gold versus dollar correlation. So down below here we see that we see this purple line rather, and notice that it spends most of its time in the negative territory. So that means the US dollar correlates negatively, most of the time correlates negatively to gold. When dollar goes up, gold usually goes down. When dollar goes down, usually gold goes up. Occasionally, that's not the case. Notice that occasionally we have positive correlation. Notice this. This is a zero line, and so occasionally we have positive correlation. And it is currently happening. We have currently a positive correlation. Both dollar and gold are more or less going up. This correlation has been quite extreme at around 70% of the time. Gold and dollar were doing the same thing. Now we're sort of rolling over towards normal correlation, which means that if dollar goes up, gold usually goes down. So let's look at dollar versus gold. Dollar is indeed rallying, approaching major breakout. If it breaks out above this level from May of this year, I think we'll see a strong move higher for dollar, especially if we break above the October 23 highs. Gold should be going down because dollar is getting stronger. It is not. It is currently not doing that, and it's abnormal relationship. So what is gold doing right this instant? Gold hit an all-time high right there on May 20th of this year and has been pulling back since. So right this instant we are below this green support resistance line, and we can actually look at dollar or the gold futures. So we're trading right around this green line, and usually or rather, if dollar strengthens, then gold should be pulling back. So for now, gold is still in an uptrend, meaning that it's in a bullish. We have a bullish bias. We want to be thinking about buying gold. We don't want to yet be thinking about selling or shorting gold. Latest alert opportunity to buy was back in February. It was a very nice move. How do I know? Opportunity to buy, close above the blue line. That's all I really needed to know. So we had a pullback towards the blue line and a close above it afterwards, where I'm hovering on 20th of February. Right this instant, so it's XAU divided by USD. So if this bottom part of this equation will get bigger, it should pull this currency pair lower. So we're waiting for that to happen. It so far hasn't happened to a very strong degree. Okay, so dollar has been more or less moving higher, but gold has not really moved lower yet. So we're waiting and to see what happened, to see what will happen. For now, I am sort of neutral to slightly bullish on gold, but I want to see where does this go. Like if dollar suddenly just pops higher, what would gold do? Will it retreat? We'll see. For now, I'm kind of just watching it and not really trading as much as I normally do gold. And that's it for this week's recap. Please let me know if you have any questions. Also, if you have any comments. So, for example, we covered, the stocks, the large cap stocks, small cap stocks, treasury bonds, dollar, gold, as well as put to call ratio. So, what do you guys think? Does anything that I was saying, does that make sense to you? Have you traded using my indicators? What is your opinion on the securities we have mentioned in this video? Make a comment in the comment section. Once you do that, head over to MasterChartsTrading.com. Click on sign up for one of the products. So I guess I have trading indicators, newsletters, and both trading indicators as one of the services. Trading indicators are these lines on the chart. You can have them on your chart once you open a free TradingView account and sign up on my site. I will open the door for you on TradingView.com for this green, blue, red, and yellow line. You can trade pretty much anything under the sun using them. The newsletters, I send out daily alerts and weekly members-only videos to my subscribers. And so, for example, this week we'll be covering all of this various securities in the members only section. I think the best deal, of course, is to get both trading indicators and the newsletters. It's a very good package and a good deal at $49.95 per month equivalent if you buy a year's worth of subscription. If you buy it monthly, it's $59.95. So you get $10 a month equivalent discount. Of course, you can just get everything separately. Thank you again for watching all the way to the end. If you have any questions, let me know. Thank you for watching and have another great trading week. Bye-bye.